So by implementing this planning tip, one family was able to improve their after-tax wealth by over $170,000 over the course of 20 years. And this is just one of various tips that we're going to cover that you can implement in your retirement plan too. And it's going to help you not only save taxes in the short term, but help you accrue greater levels of wealth in the long run. If you're new here, we help federal employees have better retirements on this channel. So if you're retired or coming up to it, then subscribe to get weekly videos. And we have some incredibly powerful tips for you this week. And so let's jump right in. Tip number one, use asset location to help you build tax-free wealth. This first one is very simple, but can have a huge impact on your retirement. If you've seen any of my content before, then you know how we've demonstrated the importance of tax planning in retirement. And being mindful of how you're realizing taxes with your income in retirement can be a total game changer. Remember, any money that you pay towards taxes in retirement is less money that you have for yourself in spending in retirement. So many of you are familiar with asset allocation, which is what kinds of investments that we hold inside our portfolios. Are they stocks? Are they bonds? Are they money markets? Are they cash alternatives, commodities, etc.? But something that's almost never talked about is asset location. This is referring to where you are holding those investments and what type of accounts you're using. Let's say we have a family that has 3 accounts, a traditional or pre-tax account with $700,000 in it, a Roth with $300,000 in it, and a joint or after-tax account with $200,000 inside. And to keep this example simple, let's assume that the asset allocation that is required for the success of their plan is 50-50. So 50% stocks and 50% bonds. Now, most people will split these bonds and stocks 50-50 in each one of the accounts. And this makes sense because you want to make sure that you have an even split between all of your accounts, right? But if we're thinking about this in terms of maximizing your retirement and building that long-term wealth, this is actually not at all what we want to do. If you think about it, stocks are generally what gives us growth in our portfolios, whereas bonds are typically used for stability or generating income for retirees. Well, growth in investments means what? Taxes, right? And we know that all traditional pre-tax accounts have a tax liability with it, meaning anytime you take money out of this account, the full amount is going to be fully taxed. So that means that as your money grows inside this account as well, that growth is going to be taxed in future years when you take the money. Now, it is tax deferred, so you get to grow the money without paying taxes. But again, the minute you pull the money out, now you're paying taxes on that amount of money that has grown, including the amount that originally was in. Not to mention, the higher your traditional retirement accounts grow, the bigger your required minimum distribution, or RMD, is going to be in the future. And this effectively means that as you grow your account, you are also increasing the amount of taxes that you're paying throughout the course of your retirement. Now, inside the Roth, any kind of growth that we have in this account is going to be completely tax-free henceforth. So if we're thinking long-term about our retirement, why wouldn't we have the most growth inside the tax-free vehicle where all of that growth gets to be tax-free? So if we go back to our example, here's how we would want to consider allocating these accounts instead. This is a total portfolio of 1.2 million. And so we have 600,000 in stocks and 600,000 in bonds. Now, inside of this Roth, we have 300,000 that's sitting totally tax-free with future growth tax-free as well. So, hey, you know what? We want this to be 100% stocks because that's where we want all of our growth to go. So we've got 300,000 in stocks already out of the allocation that we have. Now, that's only half of the stocks that we actually need. So when we look at the other 2 accounts, either the joint brokerage or after-tax dollars, or the tax-deferred traditional, like traditional TSP, traditional IRA, 401k, between these 2, which one do you think we would want to allocate this to? I would likely also consider putting stocks inside the taxable account instead of the retirement account. Now, why is that? Well, when we think about how the taxes are applied, because remember, we're doing this more advanced planning, we're thinking long-term about taxes and not just throwing investments wherever they seem like they fit. The non-retirement accounts are going to be taxed at capital gains rates, where the retirement account is going to be taxed at ordinary income rates. Income tax rates are much higher than capital gains taxes for most people. So when we think about capital gains taxes, for most federal employees, it's going to be around 15%. And how does that compare to a retirement account or income tax? Well, for most feds, it could be something like 22% or maybe even 28%, depending on how much taxable income you have. Not to mention, inside the non-qualified accounts or the brokerages, we can create tax savings by using strategies like tax loss harvesting and others, which can help you reduce the taxes on the growth that you're earning. So yes, there is tax on the growth inside this account compared to the retirement accounts, but you have a pretty good chance of being able to offset if you have the right systems in place. Now, this is also what we call your back pocket money. This is an account where you don't have to worry so much about taxes. You might even be able to take some cash out without realizing taxes at all, like we talked about. Whereas a traditional retirement account, you have to worry about taxes for the whole amount. So we don't want to be 100% stocks with this 200,000. Because what if you need some kind of liquidity event for something? So I would say something like 150,000 out of that 200 could be stocks, and then the other 50 could be bonds, which means we still have 150,000 in stocks to meet that 50-50 allocation. So we move the remaining here, and the remaining required to give us a 50-50 allocation would be 550 in bonds. Now, there's another reason you might want to consider bonds inside the traditional retirement accounts. If you consider what high yield bonds pay and their taxability relative to other kinds of investment strategies, they are a much less tax efficient vehicle than, say, tax managed ETFs or municipal bonds. So if you hold it inside this account that is taxable, high yield bonds are going to generate more taxes than if you were to hold more efficient investments. Now, I know this can get a little confusing. So on your screen, you're going to see an image of tax efficiency for various types of investments and how they rank to one another. Now, I'll leave it up for a few seconds so that you can take a picture or a screenshot for yourself. So when we think about that joint brokerage, that 50,000 that is not in stocks, you would want to consider something like muni bonds or other more conservative cash alternatives, but making sure that they are still very tax efficient. And for the stocks inside that account, tax managed ETFs are going to be much more efficient than something like an index mutual fund where there's capital gains distributions and all kinds of other things that create extra taxes that you shouldn't have to pay. But talk is cheap. So we ran a scenario so that you could see the impact of two different circumstances, one in which this was employed correctly and the other that was being haphazard. And we can see that by implementing this strategy in this model, it allowed a family to be able to keep $170,000 more of their wealth instead of having to pay that in taxes. This comes from the form of not having to pay as much taxes, as well as having the growth be tax-free as well, which is, again, less taxes that would have had to been paid. And this was without changing very much of the investments at all, but merely having the investments inside the appropriate location. Now, we usually get the question, which kinds of stocks and bonds should we be using in our portfolio? That's going to depend on a lot of other factors, but at least you start to get the idea of how you should be thinking about this structurally for your own retirement plan. All right, moving on. Tip number 2. Take advantage of the lower tax brackets currently available within the Tax Cuts and Jobs Act. In 2018, there was a new tax law that came into place that temporarily reduced the tax brackets. Now, the thing to know here is that these reduced rates are not permanent, and the law actually has what's called a sunset built into it, which means that these tax rates are going to go back to the original rates in 2026. And so, unless Congress extends the law or actually changes it altogether, we can expect rates to jump back up again. And if you're coming up to retirement or you're already retired, these rates right now could be the lowest tax brackets that you have available throughout your retirement. But in the meantime, you may want to consider things like Roth conversions and fill up those extra brackets if you have the room. Here's how it works. Let's say that the amount of income that you need to generate for your lifestyle expenses takes you to right about here. Well, if you think about it, you still have this much room left inside your 12% bracket before you hit that 22% bracket. If we're anticipating that if this law sunsets, all of these rates are going to increase in the future, then doesn't it stand to reason to go ahead and maybe do a Roth conversion for that chunk of money while you're still in the 12% bracket and not quite at the 22%? The next tip you need to know about is to use your taxable accounts strategically. Now, when we say taxable accounts, we mean non-qualified accounts. A lot of you might be scratching your head. It's a lot of lingo. Think of non-qualified as an account that's not qualified for tax preference. That's an easy way to remember them. So qualified are retirement accounts and non-qualified are not. So these would be things like individual accounts or joint accounts, trusts, things of that nature. And these types of accounts can be very powerful in your situation, but only if you use them correctly. Now, the crazy thing is that traditional financial advice indicates that you should be spending down these non-retirement accounts first before you spend any other assets. But this is yet another one of those rules of thumb that can actually do more harm than good. While these accounts don't have tax preference and they're not tax deferred like retirement accounts, they do have a much more preferable tax rate to the taxes that are applied. We talked about this a little bit earlier. The taxes for these kinds of accounts would be capital gains taxes, whereas taxes on retirement accounts are income tax. And it's important to understand how your money is taxed in the eyes of the IRS. So let's look at this together. What fills your income tax brackets first are always things like your FERS pension, your income, Social Security, guaranteed annuities, etc. From there, you stack on tax-deferred withdrawals, for instance, like the traditional TSP, traditional IRAs, or any kind of withdrawals that come out of those accounts. Now, finally and lastly is where capital gains is stacked on top, and this is where the magic happens. You'll notice that because of your first pension, Social Security, and maybe some other account distributions, you may have already realized the amount that takes you all the way to the 22% tax bracket compared to the capital gains taxes where it's 15%, and you're saving yourself 7% on that distribution. If you factor this on a monthly basis, this can really add up in your retirement. And here's where it gets really good. Let's say, for instance, that you have a taxable income of $100,000. This is counting your FERS pension, your Social Security, maybe some TSP withdrawals, etc. You'll notice that because you're over the 89,450, you are already in the 22% bracket when it comes to income tax. So if you were to take another withdrawal from your traditional TSP or IRA 401k, that full distribution is going to be subject to 22% federal tax as well as state tax depending on where you live. Whereas if you took an additional distribution from your joint account that is subject to capital gains instead of income tax, then you'll notice that over here you are higher than the 89,250, but you're still only in the 15% bracket. So you saved yourself 7% in taxes just on that one distribution. Now, think about if you were to incorporate something like this on a regular basis for your monthly income. And this is where that income planning and the income systems you develop for yourself in retirement can be truly valuable in allowing you to keep more of the hard-earned money that you have. For example, let's say you need $25,000 for something, and you follow traditional financial advice that says you spend down all of your taxable assets first. Well, that means that now you no longer have the ability to take it out of an account that has capital gains. You're forced to take it out of an account that is subject to ordinary income tax. Well, if you need to take home $25,000 and you also need to pay 22% federal income tax on top of that, plus state, you might actually be looking at a $35,000 or possibly even $40,000 distribution that has to come out of your portfolio, because after the taxes is when you'll get the $25,000 net. So you can really see how this can be game-changing in retirement, because if you're having to take bigger distributions and do accelerated withdrawals just to cover the taxes, how much quicker is that going to draw down your portfolio? Any one of these can have a big impact on your retirement, and if you can implement more than one or various of these strategies simultaneously, then you're well on your way of having a much better and more stable retirement plan. And for more videos on how to make your retirement better, check out these videos on your screen, but give us a thumbs up on your way out. And until next time, stay wise and stay wealthy.